Options traders love to talk about the Greeks, but few concepts are as important and as misunderstood as delta hedging. In this video, we'll walk through what delta hedging is, why traders adjust positions intraday, and how professionals use this tool to stay market neutral. What delta really means. Let's start with the basics. Delta measures how much an option's price changes relative to a $1 move in the underlying stock. A call with a delta of plus 0.50 gains about 50 cents if the stock rises $1. A put with a delta of minus 0.50 loses about 50 cents if the stock rises $1. When you hold an options position, the net delta tells you how much directional exposure you actually have, even if you didn't mean to take a directional bet. The goal of delta hedging. Delta hedging is all about staying neutral. Say you're short options as a market maker or volatility trader. You don't want to gamble on whether the stock goes up or down. You just want to capture time decay and manage volatility. To do that, you use shares of the underlying stock to offset the delta of your options. Example: if your option position is plus 100 deltas, you can short 100 shares of stock. If your option position is minus 250 deltas, you buy 250 shares of stock. Now, regardless of the next small move, you've neutralized your immediate directional exposure. Why it's called dynamic. Here's where it gets tricky. Delta isn't fixed. As the stock price moves, delta shifts. This is called gamma. If volatility changes, deltas can shift too. That's why hedging isn't a one-and-done process. Professionals adjust positions intraday, sometimes many times, to keep exposure close to neutral. It's like steering a car. You can't set the wheel once and expect to stay on the road. You need constant small adjustments, practical challenges, and costs. Dynamic hedging sounds perfect, but there are trade-offs. Transaction costs. Every hedge means trading stock, which racks up commissions and spreads. Slippage markets move fast, and you may not hedge at the exact price you wanted. Over-hedging risk. Adjust too often, and you may turn noise into losses. Adjust too little, and you're exposed to big moves. Capital requirements. Constantly trading stock requires margin and liquidity that small accounts may not have. This is why delta hedging is mainly a professional's game. Think market makers and hedge funds, not casual retail traders. When dynamic delta hedging makes sense. If you're trading large size and can't afford directional risk. If you're running a volatility strategy like short straddles or gamma scalping. Or if you're an institution needing to stay neutral while managing big books of options. For everyday traders, it's usually better to size positions so you can tolerate the delta swings, rather than trying to constantly hedge like a pro. To sum it up, delta hedging uses stock positions to keep your options exposure neutral. It's called dynamic because delta is always changing, so hedges must be adjusted intraday. It's a core tool for professionals, but costs and complexity make it impractical for most retail traders. Still, understanding dynamic delta hedging is key to seeing how the pros manage risk behind the scenes. Thanks for joining us. If you found this breakdown useful, hit like, subscribe for more advanced strategies, and drop a comment. Would you ever try hedging your deltas intraday?